This is fundraising in an economic downturn, what to expect and how to win. There's a lot to talk about here, but we're really going to be trying to drive a lot of improvement in you and your approach to fundraising, especially in these new times. In the Zoom chat, we'll be monitoring questions. Jonathan will be looking at it. If there's anything that I need to react to or any of the guests, we'll be sure to call those things out. We also are going to be doing Q&A at the end of this session. We have a form that I think Jonathan has sent through. If you have any burning questions that you want to make sure we get to, please submit them there. I'll reference those first as we get to the questions, but we're not trying to keep it to ourselves. We're really trying to help the whole community. So if there's anything, feel free to screenshot things, feel free to send them out, share on social, tag us all. That would be awesome. So let's jump into it. Before we talk to Elizabeth and Mac, I just want to make sure that we set the stage a little bit. So this is going to be a 3-part workshop. You really can't cover any of this in an hour. You can't really even do it in 3 hours, but we're going to try to peel off some of the most important things that you have to recognize when it comes to this new fundraising environment. And before we get started, I want to share some of the backgrounds of the people that you're going to be hearing from. Some of you may know me from my content, but I'll just quickly give you my background. Started my career at MLB.com, where I led the new media product group. I was an investor at Greycroft, a New York and LA based firm. Was a startup founder, raised a couple $1 million a couple of different times. The last one was a company called Tape that I was co-founder and CEO of. We had an exit in 2020. I then transitioned into doing this. It started off as a hobby, and then I got picked up by Silicon Valley Bank to run workshops around fundraising, and then decided to go full-time around this company, which I describe as being focused on making fundraising easier and more accessible to as many founders as possible. We do that through content, workshops like this, free tool, and different programs. I'd love for you to check out my podcast. Our guests, I'm not going to bring them up yet. I'd like to brag about them first, because I know they're not very good at that. Elizabeth Yin is co-founder and general partner at the Hustle Fund. Before that, she was a partner at 500 Startups. Before that, she was a founder multiple times over. She was early on at Google, and she has one of the most incredible Twitter feeds and newsletters you'll see out there. Definitely encourage that follow. So you can use that QR code or that handle. And then Matt Conwell started his career as an engineer, worked his way into venture capital, first at Tedco before starting his own company, Rare Breed Ventures. He has an incredible story around the hustle that it took to start his first time fund. He is also amazing on social, really great follow. So why did I start there? I didn't start there to brag about myself. Of course not. I do bragging about guests because it makes me look better that I was able to get these amazing guests. No, the reason I start there is because of a perspective I have on advice. I think with any type of advice, whether it's from your friend down the street or an amazing like Elizabeth or from my newsletter, advice is all about context. Advice is really hard to understand until you start peeling back the layers and really understand where someone comes from. Because in this game, fundraising in particular, but startups in general, almost any topic worth giving advice around, you'll probably get 2 equally credible people that will give you 180-degree exact opposite piece of advice, especially if it's boiled down to a soundbite or something on Twitter. If you've been to any of my lectures or workshops, you've seen me talk about this. So you guys can read this. This is Andrea Funston from Basecamp Ventures and Mark Suster. They're talking about data rooms. And on one side, Andrea is, I advise all founders, the moment you meet a VC, you share the data room. Show the data room. It's amazing, amazing, amazing. While Mark Suster has a blog post that says never share a data room. So the interesting thing here is that if you were to get these 2 investors to sit down, break bread, and talk about what they actually believe, they would probably agree on most things. The way it comes out in a Twitter post and the way it comes out in a piece of advice can be so misleading. Even in this workshop, we're going to do our best to give you context and teach first principles so that you can be creative around how you problem solve. But it's going to be up to you to remember what my background is, what Elizabeth's background is, what Mac's background is, and think to yourself, like, why are they telling me to do this? What is their experience? What are the things that they believe in? Okay, so that's my preamble to almost any workshop that I give. But from here, let's talk about workshop goals. So in all of my workshops, you have 45 minutes maybe with founders, and trying not to be a talking head where it's just pontificate, show that you know what you're talking about. What you really try to drive towards is actually providing value and providing solutions. And so I know some of you will be jumping in and out. I want to start by delivering immediate value and asking you all a quick question. We polled a lot of you to see what the biggest challenges were and asked what are top things people are anxious about, where people need support. Anyone want to guess what the top 2 or 3 anxieties were? You can send it in the chat. We'll start monitoring it a little bit. And we're not going to shame you for your anxieties. FOMO, raising money, getting connections, meeting investors. Great. These are all very good responses. So here's a little bar chart of where anxieties were. A lot of times you'll have anxieties about anything, but fundraising in particular, and you think you're the only one. You think you're the only one that has to deal with, I don't know if I'm pitching my story. It turns out that everyone is the same, and it feels much easier to tackle these things if you see that it's represented like this. So storytelling, pitching, and confidence is number 1, followed up by building a network. And how do you connect with investors? What are the right investors you should connect with? And then everyone is very anxious about time management and like, how do I get this done? Will I get this done in enough time? How do I be efficient? And I wanted to call out the second one, which is the who, building this network and connecting with investors. Who should I pitch? Do I know who would be interested? Who in the world should I even start with? And they always come to this question, do you have a list of investors that I could reach out to? Give me lists, like investor lists in my experience. And I've been very focused on trying to provide tools and resources for founders. Investor lists are the number 1 most desired resource. I'm a little ashamed to admit it, but like when we think about lead magnets, we think about attracting attention. We're like, should we build another list of investors? And I'll tell you, lists are valuable, but before I give you the jackpot, the gold at the end of this rainbow, I do want to say that lists are valuable, but a lot of the lists that you find have very short shelf lives. They change a lot. And the more important part of lists is what you do after the list. That's going to be an encouragement for afterwards about how you think about fundraising, and just don't rely on big, massive lists. That being said, it is valuable. And so we had some founders actually reach out and they're like, lists. All these lists are expired. Jonathan and I and the rest of the team went out and researched, try to pull together the most recent lists that other people had compiled, and then did our own research to grab a list. Interesting factoid, there are 1,000 firms focused mostly on the United States, fund sizes between $8 and $500 million that have at least 75% dry powder right now. It's crazy. And limited to, closing their fund since 2020. So that should give everyone a little bit of excitement about what's the light at the end of this crappy summer tunnel, is that there is a lot of money to be invested and it will be invested. What is the first value that we give to everyone? It's a bit of a thank you for showing up and making sure that Elizabeth and Mac feel welcome. Afterwards, alongside notes about this event and recordings, we're going to be sharing for all the registered users a compilation of these investor lists. So that's really fun and excited to be able to deliver that to you. That was a lot of work. So thank you, Jonathan. And then secondly, the question and the concern is, how do I contact investors and who will take my meetings? Here's your second jackpot. There are a lot of investors that say they take cold outreach, that, oh yeah, reach out to me, send me an email. We like looking at cold deals. I'll tell you from my experience, being on that side of the table and understanding, it can be a lot of lip service because it's so easy to get an email and just not do anything with it. And maybe use it for information, maybe put it in your CRM system. But I'm excited to say that the 2 guests that we have today practice what they preach, both Elizabeth and Mac. Maybe we'll talk to Elizabeth about this later, but I've seen her share that 15% of her portfolio comes from completely cold outreach. And even for me, that is shockingly high. Amazing that they have a process where they can find signal in cold outreach, but 15% of her really incredible portfolio comes cold. And Mac has been an outspoken supporter of investing off of cold reach because he also thinks about the way the system works today with warm outreach and how it favors certain networks, and underrepresented founders have harder times actually cracking those networks. So both of these people really love cold outreach. So connect with them. Hustlefund.vc also has an intake form, so I'd highly recommend you go there. And the last part of this whole thing is that it's not even that cold anymore. You can start referencing this. You saw them in a workshop. You loved what they had to say, referencing specific things. Okay. So that's the first part of the workshop, trying to address some of your biggest anxieties. I hope that's helpful. Let's move on. So we are talking about fundraising in an economic downturn. And the reason this even came about, this actually all came about rather quickly, maybe in a week and a half. It was because of reaction I was getting on social. It was because of some things that I was seeing with different founders. But I've talked to more than a handful of founders who honestly, just because of really bad timing, have had to start to raise over the summer. I'm sure Elizabeth and Mac have stories of this. I keep in touch with a lot of founders and had founders who were executing through January, February, and they're like, we're going to go out and raise in like March, April, we'll get it done before the summer and we'll be good to go. And that was the right way to play it. They just ran into a train and got stuck where they weren't able to raise during the crash month of May and then had to go out in July. And what I noticed in these founders was they were having a really hard time adjusting to this idea that the market was changing. It was like, I get that the market is changing. I've seen the headlines, but either they'd say, oh, I know Regina Jasmine. I heard she raised X and she only had Y. Tessa Brown did it too. Why can't I do it? And oh, Jason Ye said he's still in market and writing checks. Like VCs are still investing. And then when they do go out, they're like, well, my last round was done at X. I should at least get 2X, right? Or whatever. And the reality was that founders today, especially ones that don't have any context further back than 2020, don't really know how to adjust. And so our focus really is going to be talking about what actually happened and what do we think the change is going to be so that you all can be ready and level set expectations and get ready to prepare for a process that you'll run fall, maybe in the winter, maybe in Q1. So we are going to disavow this idea that you could just maintain the status quo and do what we did before in order to be successful, because I think if you do that, you're going to be in for a hard time. And we're going to start a little bit in a recap of the last few years. I'm going to explicitly introduce Elizabeth and Mac at some point, but I do want to invite them as I go through any of this history. But I want to start in the recap of the last few years. This is based on my own philosophies on how to teach anything, but teach startups and fundraising, is that you have to know some of the underlying context and reasons for any of these things, essentially first principle thinking. I don't want to use that buzzword, but like first principle thinking about what's going on, because I never want any founder to hear advice or a thing, do this, or realize that investors will be expecting lower valuations without understanding why. Because if you're just like blindly following, then anytime something is slightly off, slightly different than what Elizabeth said or what Max said, you're going to freeze up because you're going to be like, they never covered that. They didn't say what happens when an investor asks me what they believe the valuation should be. So we want you to understand what's going on here. So maybe you can understand the money of the investor and what you need to do. Let's talk about the macro environment over the last few years. I am old enough to remember when I was living in New York City, when the sky was falling in the last recession in 2008, when my investment banker friends told me, you won't be able to pull money out of ATMs. It's going to be crazy. And then it started resetting and things started chugging back. And after 7 years, at that time, I was an investor at Graycroft. And I remember in 2015 being at one of our partner meetings. And one of the partners being like, okay, we're entering year 7. Things are crazy. This can't last. We should sell the companies we need to sell, make sure our founders raise capital when they can. Let's make sure people cut burn. This is 2015. And it just kept going. It went maybe a little bit of flattening here and there, but it just kept going until 2022. There were years of low interest rates. So tons of essentially free money getting out there. The public market reacted. There was a bull run for this essentially the last 15 years. Crypto was this crazy X factor in all of this. Essentially personal wealth transfer and personal wealth explosion via crypto has been a factor. And then we can't overlook the COVID stimulus, people having additional dollars to spend, sometimes on venture-backed startups. So how did that impact startups? There was a lot of money to be invested and people were making money in the public markets. And then bigger guys like Tiger were searching for alpha, searching for more ways to make money. So with billions of dollars in assets, they were going earlier and earlier and earlier, piling money into startups, piling money into earlier stage companies. There was this interesting dynamic around faster liquidity in Web3, which I hope is less of a driver now for Web3 companies. But back in the day, the realization was that you could make bets and you didn't even have to be betting on the once and future king of the future, the IPO, massive one winner. You're like, can we just get to an ICO or can we just get to a token offering? And so if that were the case, you could put more money into these companies, you could possibly get faster liquidity. I'll mention it. There were new people that came to market, new GPs, new solo investors who didn't come from a different era. And with everything going up and up and their money coming in and then them needing to compete for deals, this really drove the market. And like I said, competition to deploy. How do I get our money in? Speed, price, et cetera, and FOMO. It was a crazy time. What did that lead to? This is what we saw across the board. Crazy inflated valuations, companies with very little raising at $50 million, $100 million valuations. And I'm sure some of you have read about a recent $1 billion valuation, but we're talking about some other companies. Lightning fast fundraises. And I'll get to a story in a second. Limited diligence, lack of oversight, and a real power shift. We saw the power dynamics in venture capital and startups really shift towards the founder, which was a cool environment to see, but also unprecedented, at least in my career. And I wanted to tell you a quick story about something I saw about 8 months ago. Yeah, about 8 months ago. I had a founder talk to me about their company, asked me just to tighten up the way they thought about approaching investors. And then a week later, they were ready to go. They're like, we started talking to investors on a Thursday. We had some first presentations on a Friday. We figured we'd take the weekend off. The VC asked for a call on Sunday and they had a term sheet on Monday. And this is a $7 million round, like not a small round, $7 million round. Elizabeth, Mac, actually, I'll start bringing you in and maybe saying hi. But I wanted to ask you, Elizabeth, any stories that you can share with the crowd? What's the craziest thing you saw in terms of the headiest times in the last 2 years? Let's see. Maybe
Hey, I can unmute myself now.
There you go. Hey, Mac, how are you doing, man?
How's it going? Elizabeth probably has far more stories about this, but in the last 2 years, like I won't even give a story. I'll give you a stat, right? So in 2019, Series D, so your Series D is like your fourth or fifth round of funding, averaged a valuation around 400 million. Actually, in 2019, beginning of 2019. By 2021, Series D rounds were up to around $1 billion valuation. That's a $600 million jump over a span of 2 years. That is not sustainable. But we saw companies during the last 2 years like raise funding 2 and 3 times in the same year. It's not normal. Right. And if you are a first-time founder and you came up in an ecosystem like that, like you start to believe, oh, this is how fundraising works.
That's right.
And now everybody's getting a reality check of, oh, we've had a really fun time for the last 3 years. That time is up. And really, honestly, it's been fairly smooth for the last 13 years. We've had a bull market in the public markets for quite some time. And venture is very closely tied to the public markets very often. If you just think about that, Series D's grew by 600 million over 2 years. That means Series C and Series B and Series A also grew significantly.
Yeah.
Now they've contracted back.
That's exactly right. We're going to get to that. That's going to be a less fun conversation, but last little nod to the heady times. Elizabeth, any crazy story that you saw, things that made your mind just blow up?
Several examples like what you gave, Jason, but actually I'll shift the conversation a little bit because I don't know what the breakdown is of this audience and how much people have raised. For much of my portfolio, actually, many of our companies did not actually benefit from this frothiness. in that most of our companies did not have these crazy things happen to them. And so what I want to say here is this may be just very mind-blowing where people are like, these crazy things didn't happen to me. And so why all of a sudden is this pullback happening in such a big way? And I think to address that, I think if you can just imagine all these investors chasing shiny objects over the last couple of years, throwing in loads of money into things that had not yet been proven, right? Like putting $7 million or $350 million into a pre-seed company, as you've seen. There's a lot of risk, and I don't really fundamentally believe you can scale a company pre-product market fit. So now all of a sudden, what you have is all these investors made all these poor investments, let's just call it out, and now everyone is scrambling, either because they lost money, and who knows, maybe they go okay in the end, but it's still early. So on paper, it feels like a big loss. And people get scared. And when they get scared, they stop investing or they reevaluate their strategy. And many people are doing that right now. And that just affects everybody. So even if you didn't reap the benefits of this frothy times, unfortunately, it does affect you and everyone else.
Elizabeth, that's a great call out. And I think it is worth saying that not everyone had access to that frothiness, which is doubly negative because I think for the founders who maybe didn't raise during the last couple of years or didn't have access to it, they certainly heard about it. And so the perception of what processes and what expectations should be is like slightly pulled. Hopefully your portfolio has obviously you as an advisor to talk through this, but for the founders out there that didn't get access to this, you still might have been reading the headlines and understanding the types of rounds that were being raised. So your expectations of what is fair and what's not fair may not actually line up with where the market is. So Elizabeth, that's a great transition to what I did want to show, which is a few things have happened. Anyone want to throw in the chat what you think some of the biggest impacts over the last, call it 6 to 12 months have been? Just want to read some of these off before we reveal. Inflation, depressed, Ukrainian war. Yep. Founders wasting money, time spent, interest rates. Okay. This one was too easy. All right. So this all kind of happened all at once, but obviously they're all slightly related, but tech stocks crashed, hacks within crypto, stable coins being attacked and falling. So the crypto winter, public market multiples crashing. Our summer 2022, by the way, which I always point out, when I say summer 2022, it's the fact that this was like the first summer since 2019 where investors actually felt comfortable, like they could go travel. And so it was like all these things happening at once. It's like crawling into a hole and sticking your head in the sand. I don't want to think about it. I'm just going to go on vacation with my family. And it's happened. And I've like heard top fund being like the whole firm went to France essentially. But yeah, and all these things have real impacts. And this is where we want to open up the conversation with Mac and Elizabeth, because this is fun. We don't know what's going to happen. This is like predicting the future, right? Like it's a market and it's a free market. People can do what they want to do. The processes can change, but the three of us have a decent amount of experience. And so at least we can reflect on what we know and what we think is going to happen, just to get the wheels turning for both of you, Elizabeth and Mac, and just as fun old time education for everyone on the call. This is something that I would put up to people as I was talking them through what processes looked like and are beginning to evolve around. Pre-2020, so think about way back pre-2020, this was a time and place where I think there are two main things to call out. Zoom pitching was not a thing. All pitching happened one-on-one. And when I say all, that sounds like an exaggeration. I feel like it wasn't really an exaggeration. Like 99% of pitching was done in person. And secondly, there wasn't this explosion of smaller funds that you could have access to. So the dynamics were much more like centralized fund based. And so when I show you this timeline of the first meeting you make with a decision maker, and that's like after going through gatekeepers and finding other people, you had all these steps of first meeting with a decision maker, then a team discussion, then additional team meetings. So meet my partner, Elizabeth, meet my partner, Mac. Let's do some diligence. Let's have that final partner meeting presentation, and then maybe a term sheet. Each of those steps essentially took a week because the cadence was every partner meeting, and partner meetings happen every week. Since 2020, things changed dramatically. The world changed, not just startups and fundraising, but the world changed. And so these timelines got compressed and then compressed some more. And now we're going to be going somewhere different. We don't know where yet, but I'd like to have that be the way we set the stage and talk about this. What are some of the things that you're telling your founders to expect when they get ready to fundraise?
So I think it feels like we're in an aura of doom and gloom, but I actually don't think it is as bad as people make it out to be. For context here, I left my cushy job at Google in November 2008. That was really doom and gloom for the next year and a half, I'd say. And I think that we're not at that point. To your point, Jason, there is a lot of money floating around out there, but I think this summer was just a big pause for all the reasons you laid out. I actually think in September, while we will not go back to roaring 2021, I do think people will be investing. I already hear murmurs of investors coming back from their summer holidays. The number of out of office emails I got from fellow VCs was incredible for a variety of reasons. And rightly, we've been all stuck at home and people want to get out of here and get out of their white padded room. I think in September actually will be I don't want to say a great time to fundraise, but I think it'll be more like 2018 fundraising or so, if I had to put a year on it. So it's not going to be easy. It's going to be a bit slower than before, but you could probably still do first meetings over Zoom. And with all the microfunds out there, I would certainly put myself in that category. They have more of a champion model, so you don't need to have like 5 partner meetings or whatever. You generally meet maybe once or twice or so. And so it's better. I think it is better.
Yeah. But before I ask you, Mac, to chime in, I'm going to push you a little bit more, Elizabeth. So it's a little bit easy to say it's going to be easier. What about when you think about easier or harder, where are you trying to push your founders when it comes to preparing, let's say, how much time they're going to need to build in? How much runway do you think you need? When do you want to start versus when cash out is?
Yeah, I think good fundraising windows are right after Labor Day and right after New Year's. Don't try to do anything around Thanksgiving and beyond. So those are the next 2 fundraising windows. You need to, I'm telling all of our founders, if you raised in the last year or so, maybe you could have had a loosey-goosey story. You can no longer have a loosey-goosey story. You need to be thinking about doing at least several reps on your deck and making sure that not only it's clear, like people can understand, but it's compelling and differentiated is actually a keyword. And then you have to run a really good process and cram in all of your meetings all at once, which means you need to take time in your schedule to actually do a concerted raise. And it means that you need to have all of your work handed off to other people, which is very challenging. I think that's the number one problem with fundraising. If you have a full-time job already plus more, and then now you have to add in a fundraise, you can't do that. Your fundraise has to be the top priority in doing this. So I don't know, it's just the stakes are higher and you have to be tighter and better.
That's super helpful. I think Mac probably has a lot of similar sentiments about what's happening, what's going on. Anything specifically around timelines that you think, if a founder were able to run an ultra tight process, let's take some guesses. I'll make some guesses too, but I don't know if you've thought about the time people are going to need in order to fundraise, because, and the reason I push both of you on this is that I used to be a seer when it came to this stuff. I could talk to a founder and they would be like, this is what's happening. I'm like, if you say this is how they'll respond and this amount of time, you can do it. I know both of you can do it too. But I knew the processes so well and the mindset. And then in 2021, I couldn't. They would tell me things like, oh, this valuation came in and this investor did this, and then they came in and then the term sheet came in and then they competed for it. I was like, wow. So I generally would always tell people, look, let's look 6 months out. Before 2020, I would be like, let's look 6 months out. You don't want to be raising with a gun to your head. If you can run a super tight process, like doing it in 6 to 8 weeks would be amazing, but let's not plan for that. Then founders almost wouldn't listen to me because things were getting done in 2 weeks. And so now I'm just trying to get people to realize that it's not going to be a week to 2 week raise, but it might not be a 6 month raise. So anyways, no one's going to hold you to this except for maybe I will. Maybe I'll blast you on social, Mac, if you're wrong here. But what do you think? Where do you think this timeline goes?
By the way, for y'all who don't know, Elizabeth is like the greatest thing that ever happened to me. Like every time I'm on a panel with her, I have to give her flowers. She is amazing. So she is the smarter one here. Just y'all remember that. When I think about timelines of fundraising, so I was a founder when I started my first company in 2000. So everything was a lot slower back then. And we've progressively seen things get faster and faster. But what I would tell founders now is it used to be, like you said, pre-2020, if you were raising a seed or Series A round, give yourself 8 to 12 weeks and put in a little bit of buffer. Make sure you got enough runway to maybe go another month and a half beyond that in case it goes long. And that's assuming that you're going to run a very tight process. And so I know that Jason's mentioned tight process a few times, and Elizabeth, what does that mean? Running a tight process means before you fundraise, you start building up and networking with investors, right? You start getting your current investors or people you've been talking to. You reach out to them, you let them know what's going on. And then you pick a day where you officially start. And what you're going to do is you're going to try and pack as many meetings as you can into as short of a timeline as you can to try and create FOMO. That's running a tight process. Like over a span of 3 or 4 weeks, you're going to have 1 to 5 pitches every single day. That's what you're shooting for. That way, the reason why you want to run it that way is you can have a meeting and before you leave, because again, it used to be all these meetings were in person, but now you can do this over Zoom, where at the end of the meeting, you can ask the investor, hey, are you interested? I would love to know because I have 32 more meetings lined up for the next 2 weeks. And I want to make sure if you're interested, I can save allocation for you. That is the FOMO game. Now, the only way that game actually works is when there's FOMO to be had. And over the last few years, we saw founders be able to create FOMO a lot easier. Now we're going to feel like it was pre-2020 where like you can run a process like that. But depending on how much traction you have, I can pretty much tell pretty quickly if there's FOMO or not.
Yeah.
I can tell really quickly if there are other investors who are interested or not.
Yeah.
If you're telling me you're raising $1 million and you're doing 2,500 a month in monthly recurring revenue, that's essentially like a little less than 40,000 a year annually. And you're telling me that you're raising $1 million and you need to know from me tomorrow. I know ain't nobody moving but so fast on that. And I know I got some time, but you still want to have the process together where you have all those meetings, because if you run into an investor that you make interested, who gives you a term sheet, the moment you get that term sheet, you can then let everybody else know, hey, I got a lead, I got a term, this is what's happening. Are you still interested? Do you want to have a second meeting?
Yeah.
And when you already have those meetings compressed, it makes that a lot easier. But everybody's going to need to be more methodical in doing and running those processes, as opposed to we have seen people do very loosey-goosey processes. We're like, I met an investor here and I met an investor there. Somebody wanted to give me money. Somebody else wanted to give me money. Hey, I raised my round.
Yeah. Mac, I think you highlight some things that gets people's eyes bugging. What does this mean and how because like I said with the beginning of soundbitey advice, and that's not Mac's fault. That's not Elizabeth's fault. It's the format. We have less than 15 minutes left here. So we have to help as much as possible. Like to peel back a layer to make you understand how things worked. It's like in late 2021, early 2022, the FOMO of seeing crazy crypto companies reach multi-billion-dollar valuations, in some cases, like reach liquidity in 2 years, meant that every investor would be thinking, like, is this the next one that gets me that Solana exit in 2 years? And then because there were pray to the gods of venture that I hit one of those. And because there had been so many investors coming into the market, people raising $2 to $20 million funds, that was happening all the time, plus AngelList SPVs. There was all this money demanding these deals. And so when you have those elements at play, a founder can basically not be great at running a process and just say a few things. And you had to take it seriously. Like you had to be like, interesting. Could this tokenized job board become the next Solana? Could this VR meets whatever become the next XYZ? There's been a clear out of that, a lot of it, right? So not as heady times. The public markets don't look like huge outcomes anymore. The growth rounds, which is what Elizabeth and Mac's portfolio sells into, are essentially dead right now. And a lot of VCs are taking their time off, licking their own personal wealth wounds, both the public markets and crypto markets. And so it is really important that you start thinking about how you build your process now. And this is why this is a 3-part workshop. We're like jumping the gun here, but we have 2 more days to talk about some of this stuff. Where I wanted to have a conversation around, because you guys see such a high volume and hopefully that deal flow is coming back, is this. So how about valuations? So this is a really fun topic because, again, no one knows. The market will dictate. And this is important for everyone here to listen to, because have you heard happiness is the difference between expectations and reality? I truly believe that overall. And in these markets, it's super important, right? Like I have founders, I had to take it off so I could lock my eyes with you guys and say, I have founders coming to me and being like, they're not taking $10 million as my valuation. I asked them what they have and they're like, you saw my deck. And I'm like, you only have a deck? $10 million. I heard Susie was doing whatever, got $15 million. Ron Scovey, he got like $20 million and I'm better than him. And I'm like, they offered you $8 million and you have nothing. And I tell founders, like the very first Series A I did in 2013 was a company doing $1 million of revenue a year. And we did it at an $8 million pre-money priced round. And so if you think about it, we are saying you are worth $8 million right now. Look around you. Are you worth $8 million? Obviously, we're baking in potential here, but just so we level set and where we're thinking about what you're trying to build and what you're trying to grow, investors are taking a risk on you. They are fiduciary to their investors. They are trying to do right by their investors. No one is trying to take advantage of anyone here. I know that is not a popular thing to do in a room of 300 mostly founders and 2 VCs, but just realize, let's level set expectations. Okay, so now we're going to start talking about valuations, because this is important, because both for the happiness of the founder and also strategy of like, what do you go out with and what do you go out with expectation wise and how to raise money? And there's like a lot of things that have moved these things around, even though round sizes are crazy huge and bigger than they need to be. The inflation of the prices of engineers have made that a requirement to some degree, at least a little bit. Maybe I'll switch it around, make sure we give Mac a chance to go first so that all the juicy answers are available to him. Any thoughts on where you see valuations landing? And we can talk about like the stage that you focus on. So I'm sure you've been thinking about it. Like, where do you want to come in here for a pre-seed round, maybe a seed round?
Valuations are really weird right now at the pre-seed and seed level. Like even pre-2020 for a seed company at a $10 million post-money valuation wasn't crazy, right? Or 8. And I've had founders go to the market and be like, well, I'm raising on at 8. And some people think that's expensive. That used to be cheap. Now that's expensive. And so I'm raising at a 5 and they're trying to push me to a 4. A 5 used to be almost as low as anybody would be willing to go. Anything lower than that, now we're going like pre-2010s. Like 2000, 2007, we're like doing like 500K on a $2 million post, $200 million, like a $2 million post was like a thing, right? We don't see $2 million valuations anymore, but maybe you're starting to. All I know is that valuations are all over the place. What I would tell founders is get comfortable with valuations lower than what you've heard from your peers over the last few years. If you get a $5 million valuation, yeah, that's pretty low. But it's also a thing of, if those are the only terms you're getting, if you need the capital, sometimes you got to go with it. If you don't need the capital, keep growing your company as much as you can. Focus on good fundamentals and good economics. And when I say good fundamentals and good economics, it really means unit economics. Like the amount of money you're spending, are you making more than you're spending? And if you're not, are you growing fast enough that like you can model out a day in the future where you're not spending more than you're making?
Yeah.
And everybody, hey, to be a great startup, you don't want to be break even. You want to grow as fast as possible. You do.
Yeah.
but I don't know if this is the market that you want to do it in just yet. Give yourself another 2-3 years and you can go back to that.
Yeah. Elizabeth, and a quick chime in here.
And I think everything Mac says here is spot on. One thing I would add is that a lot of people get, I don't know, they take their valuation of their company very personally. Like, this is how much I'm worth, or this is how much my company is worth. But actually, valuation is not really about that at all. Valuation is a reflection of market dynamics of supply and demand on both sides. If you don't need any money, to Mac's point, then you can more or less command whatever valuation you want, where it's, I'm going to walk. If I don't get this, I'm going to walk. Now, of course, the more you need the money, the more you're desperate for money, then you have less leverage there. And then on the flip side, for investors, I'll just give you what I didn't understand when I was an entrepreneur was that investors don't invest because a company is good or is going to make them money. That's not it at all. Investors have a limited amount of money. I have X number of checks to write every month. What is the best use of that money, in my opinion, which may or may not be right, but I'm sure we are passing on many phenomenal companies. But because of that scarcity, I have to make a decision, and this is where valuation comes in. What is the best sort of deal I can do with this money for my investors? Remember, this is not my personal money. I'm representing a whole slew of people who have been trusting me with their money. So that's where valuation comes in, where people may think, why don't they just come up to this? It only is a little bit, a couple more percentage points or whatever it is. But you know what? There are like 5 other companies we're also considering, and there's some subset that's going to get no's. So we have to figure out who's going to get no's. And that's what I didn't see as a founder. I didn't see all those other companies that were there. But you know what? You are actually competing in a market with other founders for a limited pool of money. And the flip side is true. Investors last year competed with each other, with other investors, to be able to get allocation into founders' rounds. So that's the market dynamic, and that's really what valuation is.
That's awesome. Those are 2 spot on perspectives and how you should be thinking about valuation. I think to wrap that up, Elizabeth's take, which is essentially supply and demand, it's a market. You're only worth what people are willing to pay for you. And I would just say that right now, there are 4 or 5 competing forces in valuations. And we don't know where this is going to net out. There's a ton of dry powder and competition to get in the best deals, which actually means more competition, more demand should drive prices up. But overall market conditions are really far down. Multiples in the later stages and the IPOs are down. So what will they be able to sell into later? They think it's going to go down. So it's going to go down. But they can't go so far down, because even if Elizabeth thinks my company is worth $2 million or $1 million, that's going to sound really predatory, even if that's what the market is saying. So maybe it's not Elizabeth, but other people. Like, I think reputation protection is actually going to play a part in propping up valuations just a little bit. And then I actually think founders are getting smarter about what are the pitfalls around overvaluation. What does it mean to get a $50 million valuation with $1,000 of monthly revenue, which I understand because I've seen that company. And what do they need to do to get that next round raised? It's a lot. And so you don't want to do that. Anyways, my take on it is that valuations are going to be depressed, but not like crater. We are just about at time. I'm going to open up Q&A in case Mac and Elizabeth can spend a little bit more time. We'll maybe go 2 minutes over. I did want to do the recap here. The big problem that we were solving here is that if you don't change the way you think about fundraising, before you go out, you're going to get burnt. Hopefully we helped solve that and describe why things are happening and where things are going. The overarching message from both Elizabeth and Mac has been, though, what you're going to see is essentially a higher bar. People are going to really require more diligence. Speed is going to slow down. More relationships, as Matt talked about. The bar for investing is going really high. I don't know if you saw this meme. It's a meme, but it's accurate. Like, it's like the top one certainly is true. The bottom one just going up. So we are going to talk about how you clear a higher bar. What are the methodologies? What are the things that you're going to have to do to actually solve that problem? That's going to be on Thursday. And we have this amazing guest, Jesse Puggi, who I've known for a number of years. We might hint at what you have to do. Elizabeth talked about it, but he's an incredible storyteller. So we're going to pick his brain. All right. If Elizabeth or Mac, I'm sorry, I did not manage this time. If you can stay any longer, that's great. If not, we also loved your time. We're going to start jumping into Q&A for another 5 minutes. One question ready to go. This is a good one for John's question was, the best way to reach out to VCs is not through cold outreach, but we have very few people who can give us warm intros. How do we get closer to VCs? Common question, I have my answer, but either one of you have a quick, I know you get this all the time. How would you help people think through that?
I think this is a very common problem. I'd say in this day and age, the world is not entirely cold. For example, Mac and I are both very active on Twitter, and we actually start to feel like, oh, we really know a bunch of people. Actually, I've never even met Mac in person. So like a lot of the people on Twitter whom we chit chat with, whether it's founders or other investors or whatever, tend to be people we actually don't know, but feel like we know really well on Twitter. And that's a good way, I think, you can start interacting. If your first interaction is a cold email, then all right, then maybe that feels very cold and very few investors will take that. But you can start building a warmer relationship, so to speak, on Twitter. I think if any of you are doing accelerators, you should certainly ask for intros from your accelerator programs, or if you have other investors already, ask for intros from them and build out your network that way. If other founders who have raised money, ask them for intros as well. Actually, founder intros tend to be the best because, I don't know, investors sometimes feel like other investors are shilling their companies almost by definition, but founders are not, right? They have nothing to gain. So those are some ideas.
I love it.
But with that, actually, I have to hop. Thank you so much for having me.
Elizabeth, thank you so much. We'll be in touch over Twitter.
Thank you.
I think you'll have a great perspective on this. Is there anything that Elizabeth didn't say that you might want to speak to around that topic?
Yeah, I would say it's all about networking. And so really, fundraising, especially your first round and even first or 2 rounds of fundraising, it's going to be a lot more to do with your network than it is about your business very often. And so it's the hardest when you're a founder who doesn't have a network, right? Because you hear this and you're like, okay, I don't have one. Now what I need to do? That means you need to go out and do networking. It means you got to go to the conferences. You got to go to the virtual conferences. If you're at a virtual conference, you put your LinkedIn in the chat. You try to meet with folks. You go to conferences and you talk to people. You go to local events. Every local community has this local startup events. There's probably an event almost every night, or at least a few times a week. You go to those, you talk to people. And what happens is you meet somebody who wants to be a mentor or advisor or thinks you're cool, who eventually tells you, oh, by the way, I know somebody at a firm. And it's really like that second and third degree of separation that you meet that gets you there. And to Elizabeth's point, other founders are great. Like some of the best intros I get come from other founders. But then also, if you're active on Twitter, if you're active on LinkedIn, if you're active in communities where investors are talking and you can interact with them, it helps build some of that. So it's all about networking. And if you don't have one, it can take time to build.
Yeah. And I think you covered so much of it. I just wanted to put up this like visualization where I think people get scared of being so far outside or feeling like they're so far away from the investor that they're trying to get to. But the reality is you might feel like you're really far away from them, but your path to their network is not that far. And I know this because all of you are founders, and founders tend to be very understanding of other founders. And so when you find founders that are in the networks that you want to get in, that may be your easiest in. There's a lot to talk about in terms of what it means to be great at networking, leading with value, leading with ways that you want to help, but just make sure that you understand that as you start building out the network there. Make sure, I assume actually all of you are following Mac. Make sure you follow Mac and Elizabeth on Twitter. It's essentially a free resource. Like you've heard this site, can't believe this site is free. It's, yeah, if you follow Mac and Elizabeth, like that's them giving away their time for free, trying to educate the market. Quick question here. Let's see. Mac, do you only invest in the United States or do you invest globally?
North America, South America, and the UK.
Oh, amazing. There's a question here, which is near and dear to my heart because I really am fascinated by LATAM and especially Brazil. How are you thinking about investing in geographies that you don't know? And if a founder who is from like a different country like Brazil wanted to catch your eye, like how would that usually happen?
If it's going to be in a place I don't know, it's going to have to come from a partner who does know that place.
There you go.
So if it's LATAM and I get something from Lolita Tal, Lolita's a friend. She only invests in Latin America. If she's sending me something, I know it's quality, something like that. And the reason being is I need to know that if I invest in a company, I have a way or I have a network of people who can help them boots on the ground style, because all kinds of crazy things happen while building a company. If you want to know like the craziest thing that's ever happened to me is I had a founder call me that US Marshals were picking them up on a Friday morning.
What?
And by the end of the day, I got them legal help and made sure they were fine. It actually wasn't that big of a deal. It's just that you really don't know what US Marshals actually do for a living until somebody gets picked up by one. But if that happened to a founder, let's say sub-Saharan Africa, where they got picked up by some legal officers, like I have no way to help them. And nor do I have necessarily a network of folks who can. So like for me, that's always the first point. If I invest in this company, can I actually help them if anything ever goes south?
Yeah.
That's hard.
That's great. Last question we'll give to Nicholas because he's had his hand patiently raised. But before we do that, because people might drop off, I love seeing the interaction in the chat. And you guys are demonstrating that first piece of networking, finding other founders who are going through the same struggle and connecting with other people. We're going to keep stimulating this community through the 3 days. So please come back. Remember that day 2 is going to be a really important part of piecing this together, talking about strategies. And then I did want to just share with you all. You could also listen to my podcast too, because I do that as a labor of love and would love for you to give me feedback there. Nicholas, are you there? Do you still have a question? And
hey, how are you?
Good.
Hey, how are you guys?
Hi, Mike. Where in the world are you?
I am in Miami. But yeah, I think it's a question I've made to Mac before, but I think it continues to be an issue and has a second part question to it. I've often heard from investors that my business is not venture backable, whereas I've heard from other investors that it is, right? So my question is, with the person that is saying, like, literally from the get-go or the first couple of minutes, this is not venture backable, is that investor worth pursuing, worth convincing and trying to change their mind? Or in the VC investor mindset, should I just go on and move on to the next, considering that it's very hard to get them out of that sort of box that they're in? If
somebody tells you that your company's not venture backable, just say thank you for your time and go to the next meeting. Like you're not going to change their mind in that meeting. There's nothing you can say in that moment that's going to change their mind at all. The only thing that's going to change their mind is when you go to your next round and you go to raise more money and you reach out to them again. Hey, I know you thought this wasn't VC backable, but we've raised money before. We're getting ready to raise more. Would you like to re-engage? They probably won't, but that's about the closest you're going to get to changing anybody's mind. You're not going to change their mind the moment somebody says that to you, like meeting done.
Yeah. I'll add a couple of things, Nicholas. I think the biggest value that you can take from that is that you didn't do enough to convince them. It might be that they really think you're not venture backable, but it's because you didn't actually convince them that you were venture backable. And overselling or actually chasing is one of the things that will turn somebody off. So I agree with Mac. You might have a 2% chance of catching their eye in your same fundraise, but you will have to build momentum from everything else in the process, and they will then have to hear about you from something else. And if they were like, oh, maybe I was wrong because Mac's now leading the deal, I'll come back in. My overarching statement around passes in general is that it can be very hard to pull signal from noise from VC passes, mostly because the number one reason people pass is that they just weren't excited enough to do the deal. A lot of people are not brave enough to actually give that reason because it's hard to articulate exactly, but I just wasn't excited. So then they give reasons, they reach for reasons that are a little package up, easily packaged. The one you'll hear the most is, I'm sorry, Danielle, you're just a little bit too early. Would love to talk to you later. You're just a little bit too early, because that's an easy way to pass without saying, I can't say exactly, you just did not excite me that much. So anyways, I know Mac and I could go forever on this, and I've seen screenshots of Mac's calendar. So even if he doesn't have a meeting right now, I'm sure he has one that's coming very soon. So Mac, did just want to say thank you for joining this. Pretty late notice too, didn't give him a lot of time to think through it, but he's very generous with his time. So thank you, Mac.
Thank you for having me. It's been a pleasure. Hopefully this was helpful. Feel free to follow me on Twitter at Matt Conwell. Check out the podcast, buildingoutloudpodcast.com. And peace out, everybody.
All right. Thanks, everyone.